Hi, I'm Joe DeLisi, and this is the Joe DeLisi Financial Advisor Podcast. I've been in this business now about 30 years, pushing 30 years. And there are certain things that I see repeat. I think there's a quote out there that says something to the effect of history doesn't repeat itself, but it rhymes. And I feel like that's me right now today. I just got back from a conference, an industry conference. And it was a relatively small crowd in a good way. There were very serious people in this crowd. We were all pretty much investment professionals. This wasn't a financial planning conference. This was an investment conference. I'd say there are 30 of us or so in the room. And the folks that got up on stage and presented to us, usually it's really good because it's very philosophical. There'll be a lot of, product talk, but in context of a philosophy or context of planning. This conference was not like that. It was a little surprising to me. This conference was basically talking about selling products, new products. So in some cases, brand new products. In some cases, relatively old products, but repackaged. And I came away from that, feeling like that is not the direction I was hoping that we would be taking this. And so when I started putting this podcast together, really even before that, I started thinking about it because I have some client reviews that were coming up, and I wanted to explain to the clients that, look, and I did have to do this. You're going to probably start hearing about these things, about a lot of, I would just call them fancy products. They may not be fancy in your brain, but in mine they were. Some of them are very bank heavy. Some of them are more private, equity and private credit. And there's a litany of stuff out there. And it got me thinking. Over 30 years, I would say, without counting, I wrote some down here so that I wouldn't forget them. Wall Street has this history of pumping and then dumping. And what I mean by that is that's kind of a stock term. Like it's an illegal situation to pump and dump. I would get out there and start, say I'm a media personality and I pump XYZ stock and I pump and everyone gets excited and they start buying. And then I pull out, I sell right before it all crashes. You can't do that. That's illegal. And yet I feel like Wall Street kind of does that. And it's not, I wouldn't say by strategy, but it occurs. And so I went back and I started jotting these things down. This is some of the stuff I've heard or seen first person in the last 30 years. And look, this time is not different. I keep hearing, this time is different. Right? I heard it from stage at this conference. So let's look back in no particular order. We've got the dot-com bubble. We've talked about that many, many times on this podcast. And you've heard me, write about it. You've heard me probably speak about it in client events. Here's some examples of the dot-com bubble. This is the late 90s to 2000. Pets.com, probably everybody's heard of that. Webvan, I had forgotten about them. E-toys. These are all IPOs. And they went from billions in market cap to pennies. And it happened quickly. So what was the pump there? The pump there, the story was the internet's going to change everything. Profits don't matter. If any of you were investing back then, or if you were advisors back then, you remember that. If quotes like, this is the new economy. Equities won't go down anymore because this time is different. The internet's going to change everything. The dump, if that was the pump, the dump was the NASDAQ lost 75% of its value roughly from 2000 to the end of 2002. And it took 12 years post 2002 to even get back to even on the NASDAQ. And I got that from Yahoo Finance. So what's the lesson here? Well, look, technology can, and it does change the world, but valuations still matter and they always will. So now we're in the whole AI story and transformation, and this time is different, and it's not. It's not. Valuations of companies still matter, and so when we have multiples that seem crazy, we have to pay attention to that. Number two, this one, Enron. We'll just call this corporate accounting scandals. This was like 2001, 2002. Enron, WorldCom, Adelphia. WorldCom was right down the road from where I lived at the time. I was living outside of DC in Virginia. The pump there, the story there was that these big companies were doing accounting differently. They were accounting for things on their books way different than corporate America ever really had before. The claim was essentially that this was new accounting. It was a new trading system. The old rules don't apply. This time is different, right? That was the story. The dump, well, you guys know the end of that story. The bankruptcies wiped out shareholders and wiped out a lot of employees' retirement accounts, actually, especially in the case of Enron and WorldCom. So what's the lesson here? Again, transparency and cash flow matter way more than creative accounting. I'm not saying that creative accounting is going on now. I'm just giving you examples of things that have happened in the past. What about the housing bubble? Yeah, pretty much everybody listening here or watching will remember this. This went from really 2003 to 2008. And this was mortgage-backed securities, which I got to tell you, these things are out there again. I'm hearing them more and more at different conferences. I'm hearing them at advisor meetings. I'm hearing people ask me about this stuff as if we all completely forgot about the great financial crisis. So what were some examples of that? Well, we've got Countrywide. Again, Countrywide was out near where I lived. New Century Financial, Bear Stearns, Lehman Brothers. The story then was, and I'm hearing it now, housing never goes down. U.S. housing never goes down. And even if it does, the financial engineering of the product spreads the risk. Literally what people were saying back then was, yeah, these individual tranches of mortgage-backed securities weren't very high quality, but if you bundle them all together, all of a sudden they became less risky. That is happening again today. I'm just warning you. I'm not speaking about a specific firm or a very specific product, but I'm hearing it. I heard it from the stage. There are products out there right now doing this exact same thing. I almost couldn't believe what I heard, but it's out there again. The dump, we remember. I mean, we probably all remember Lehman's collapse, the global financial crisis. And so really what you have to remember is leverage is really going to amplify both your booms and your busts. Now, this is important if you have, I'd say, young adult or adult children, because what I'm seeing is a lot of my clients who have young adult children in their early 20s, they are very heavy in options. And they're telling their parents, they're telling mom and dad, 50 and 60-year-old mom and dad, that options trading is not a problem. You just have to know what you're doing. Options trading is leverage. And so just be very careful. And so if you've got adult children, you probably want to, sit down and have a conversation about what this has looked like in the past. Some very smart people lost everything in the great financial crisis. Now we've got China. This one, not many people talk about this. This is like a commodities, super cycle from 2003 to roughly 2011. A lot of rare earth metals, copper, nickel, that kind of stuff. And the story back then, and I remember this very, very clearly, that China's urbanization, China has so many people that it was endless. So the demand for the raw materials is infinite. China will never stop growing. They were doing 15 to 20% year over year growth. The dump was post 2011, those commodity prices absolutely crashed. Look, cycles always revert. Kind of like if you're looking at, the past 5 years as an example, if you go to a Yahoo Finance or something like that, and you just run the S&P 500, the last 5 years, the annualized return is roughly 20% per year. But the last 100 years, the S&P 500 annualized return is about 10. So it's not likely that the next 100 years, the S&P is going to go 20% every year, right? So it's got to revert back. Cycles revert back. Products revert back. Companies revert back. It's just kind of how it works. And so there's no such thing as infinite demand. There's no such thing as, this time is different and these returns are going to be there forever. What about crypto? We're in that now. But really the height of it was 2017, 18, and really 21, 22. Remember Dogecoin? Remember FTX? Sam Bankman-Fried? And the story, the pump was blockchain is the new internet. Central banks are obsolete. The U.S. reserve currency is no longer going to be the reserve currency, or the dollar won't be the reserve currency anymore. And yet trillions were lost. A lot of those tokens have gone to zero. A lot of it was built on nothing but Ponzi schemes. And so, look, innovation's real. I'm not speaking to the blockchain. I'm not even talking about crypto in particular. But the speculation, whether it be crypto, real estate, or traditional investments, that kind of frothy speculation tends to destroy wealth. Let's jump down here. Meme stocks, GameStop, AMC, Bed Bath & Beyond. this was all David and Goliath kind of stories. That was sort of the pump. But that reversed, and the people who got in late got crushed. So crowds can move markets short term, but that's not going to last. And like we talk about, you can't predict the future. So you don't know how to time it. You don't know when to get in and when to get out. You got to be right twice all the time. And then you leverage that in the situation of these meme stocks. And so I had clients calling me and saying, buy me AMC and buy me this and buy me that. We wouldn't do it. And I'm glad we didn't, because those people lost a lot of money. Most of them did. There's others, cannabis stocks, those things went flying high and then crashed because there was an oversupply. Right now we're kind of in the middle of the AI mini boom. Each thing is like, well, this is the new dawn. This is the new thing. Get in. And then it's just happening so quickly though. Things change too quickly and people don't know when to get in and get out. What about gold and silver? I mean, we've had huge runs in gold recently. And so people will point to that and be like, well, this time is different. And they start marrying different stories up. And I'm going to tell you, Wall Street's perfectly happy to jump in and sell you products that are bundled into whatever story you want to buy into. But gold reverts to its mean as well. We've got long-standing returns on gold. We kind of know how that asset category moves over time. Don't get caught up because you're going to wind up, or you could wind up in 30 or 40% correction territory there. And then finally, I would say things right now like, again, private equity, private credit. There's a lot of different bank products out there. Again, collateralized mortgage applications, a lot of stuff that's just being pushed out there again. That is being hyped. So I'm not predicting the future. Like I always say, I don't know what's going to happen, but here's what I do know. If we build your portfolio based on science and not speculation, you are on very solid territory. It doesn't mean your portfolio may not ever go down, from time to time. It certainly will. In fact, we kind of want it to. It allows us to rebalance. It allows us to buy things low, sell high and buy low, which is what we want to do. But that's a much more scientific approach than meme stock buying or cannabis stock buying or the litany of things with AI, or back in the day when it was CMOs and it was real estate never goes down and all that kind of stuff. So we want to stay the course. This time is not different. Although I am getting wary because I hear a lot of new information out there right now, and it's that hype. It's that hype that has me concerned. So just stay on alert. If something comes across your email or your radar, or your friend or your neighbor talks to you about some sort of fancy investment, just give us a call. We'll walk you through it. We'll look at it honestly. We'll read about it, and we'll kind of tell you what we think about that.
Registered representative and financial advisor of Park Avenue Securities, LLC, OSJ 5280 Carroll Canyon Road, 3300 San Diego, Cal 91212 619 Securities products and advisory services offered through PAS member FINRA SIPC. Financial representative of the Guardian Racked Insurance Company of America, Guardian New York, New York. PAS is a wholly owned subsidiary of Guardian. Westpac Wealth Partners, LLC is not an affiliate or subsidiary of PAS or Guardian. Insurance products offered through Westpac Wealth Partners and Insurance Services, LLC, a DBA of Westpac Wealth Partners, LLC, CA Insurance License Number 0D-44102. This podcast is for informational purposes only. It is not to be considered as tax, legal, or investment advice. All of the information has been gathered from sources believed to be reliable. Please note that individual situation can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guardian, its subsidiaries, agents, and employees do not provide science, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. Past performance is not a guarantee of future results. All investments and investment strategies contain risk and may lose value. Diversification does not guarantee profit or protecting against market loss. Equities may decline if valued with real and perceived general market, economic, and industry conditions. Investing in securities of smaller companies tends to be more volatile and less liquid in securities of larger companies. Investing in the bond market is subject to strained risk, including market interest rate, issuer credit, and inflation risk. And this is our managed. One cannot invest directly in an index. This material is intended for general use, but providing this content, Park Equity Securities LLC and your financial representative are not undertaking to provide investment advice or make a recommendation for a specific individual or situation, or to otherwise act in a fiduciary capacity. FF 5464561.1 expires October 2027.